If you own your own home, you're probably not going to like this video because I'm about to argue that renting and investing the difference is financially smarter than buying a house. Not emotionally smarter, not socially smarter, financially smarter. And before you smash the comment section and tell me that I'm broke and jealous, let me show you the maths. You see, we've all been told the same thing. Renting is dead money and you're paying someone else's mortgage. Property only goes one way and that's up. But here's the problem. That narrative was built in a very specific era. An era that had high wage growth and cheap houses, falling interest rates from the 1980s to 2021. This environment simply does not exist anymore. Today, the UK average house price is £285,000. The London average house price is over £500,000. Mortgage interest rates are 5 to 6%. You've got stamp duty, legal fees, maintenance, insurance, service charges, and opportunity cost. And nobody talks about this opportunity cost, and that's what I really want to get into. So let's talk about it. Let's take two identical people. Both of these people earn £40,000 per year. Let's say that person A buys a house and person B rents and they invest the difference. Now let's break this down properly. So person A, the buyer, they buy a £300,000 house. A 10% deposit is £30,000. Stamp duty and legal fees roughly come in at between £5,000 and £7,000. So before they even move in, they've spent about £35,000 to £40,000. And the mortgage is at 5.5% interest over 30 years. So the monthly payment is roughly £1,700. And over the first 5 years of that mortgage payment, the majority of that £1,700 is going towards paying down the interest. On a £270,000 mortgage at 5.5% interest rate, you pay roughly £14,850 in interest in year one alone. That's not equity. That's rent, but not to a landlord, that's rent to the bank. But wait, it gets even better. If we add in the maintenance rule of thumb, which is that maintenance will cost around 1% of property value per year, that's £3,000 per year going towards maintenance. So your roof, your boiler, your windows, any little surprises that come up, you are liable for them. So realistically, you haven't just got the £1,700 mortgage payment, you've got £250 maintenance monthly equivalent as well, which brings the true cost of owning this house to £1,950 per month. And that's before you factor in renovations or do anything fancy to the house. Now let's talk about person B, the renter. So let's assume the renter lives in the same area. They rent the same property for £1,400 per calendar month. So they're saving off the bat roughly £550 per month. Plus, they didn't sink the £35,000 into the deposit for the property. Let's say they invest that money. That's £35,000 upfront going into the market and £550 being invested every single month. Now, historically, global equities return around 7 to 10% per year long term. So after 10 years, that £35,000 invested at 8% is worth roughly £75,000. And that £550 per month invested for 10 years at 8% brings that total to around £100,000. So the total portfolio amount after 10 years of investing is worth around £175,000. Now let's look at the homeowner. After 10 years, they still owe roughly £220,000. So equity equals the house value minus the mortgage which is owed. So if the house grows at roughly 3% per year, which is the UK long-term average, which roughly tracks the inflation, the £300,000 house becomes £403,000 after 10 years. So your equity is £403,000 minus £220,000, so it's £183,000. So it sounds about right, doesn't it? Sounds kind of close. But here's the catch. The homeowner also paid £150,000 in mortgage payments, £30,000 in maintenance, and £7,000 in upfront fees. The renter, they have a liquid portfolio, they're flexible, and their money's compounding in the stock market. And the homeowner is concentrated in one illiquid asset. But a renter can move, can downsize, can relocate for a higher paying job, can access their investments instantly, and can overall be more liquid. So flexibility has financial value, and a lot of people don't take this into account when they look at renting versus buying. And people massively underestimate this. So the common argument that we seem to get when it comes to buying property is the fact that houses do go up. And yes, this is true, but so do stocks. Over the last 100 years, UK property has given around 3 to 5% real return over the long term, whereas global equities have given around 7% real return long term. And stocks don't require new boilers, roof repairs, stamp duty, estate agent fees, or conveyancing. Plus, here's the real controversial bit that a lot of people are not going to like. Your house does not produce income unless you rent it out. It sits there. But your stocks, however, they give you dividends, they give you compounding, and they allow you to reinvest your income back into buying more stocks. And compounding in the stock market is a lot more violent over longer periods of time. Now let's talk about the psychological bias. Yes, owning a house feels safer. You're not at the whim of your landlord. And you can see your investment, you can see your asset, you can touch it, it's tangible. But financially, it's simply one asset in one location in one country. But when you invest in global markets, you own thousands of companies across the world. AI, energy, healthcare, tech, consumer brands. Diversification matters, and the stock market definitely gives you that. So we've spoken a lot about when renting makes more sense, but when does buying make more sense to an individual? Let's be balanced here. Buying makes sense if you plan to stay in the house for 15 to 20 years, you value stability over optimization, you want emotional security, you have a low fixed rate mortgage, or you're disciplined and you would not invest the difference. Because here's the brutal truth that I also want to touch on. Most people who are renting right now are not investing the difference between what a mortgage would cost them and what they're paying every month in rent. They upgrade their cars, they go on holidays, and they increase their lifestyle. And that's why renting fails for most people. Not because renting is worse, but because the discipline is rare. Now let's talk about the freedom factor. Let me ask you something. If you got a job offer tomorrow, paying £20,000 more per year in another city, could you move instantly? If you were renting, yes you could. But if you own, good luck with that. The transactional costs of buying and selling property in the UK can be as high as 5 to 10%. So on a £400,000 house, that's £20,000 to £40,000 every single time you want to make that move. And this destroys any returns that you get. So the stock market is liquid, but property is very illiquid and very sticky. Now let's talk about the real wealth builders. Here's what actually builds wealth. Having a high income, having a high savings rate, consistently investing in the stock market, and compounding your money over decades. Not granite worktops, not driveway upgrades. Ownership is emotional. Investing is mathematical. So here's a statement that's going to trigger a lot of people. For high earners in expensive cities, renting and aggressively investing can outperform homeownership over a 10 to 20 year period. And if you disagree, good. Tell me why in the comments. I want to see your numbers. Because most people arguing for property don't actually run the numbers and look at the comparison. They simply run off emotion or what they've been told by their elders. And here's the final truth. The goal isn't to own a house. The goal is financial freedom. If renting and investing gets you there faster, why are you chasing bricks and mortar? And if owning gives you peace of mind, that's fine. But stop pretending renting is dead money. Interest is dead money too. At least rent doesn't lock you in for 30 years of debt. So whilst I've still got you here, please comment below. Are you team buy or team rent and invest? Back it up with numbers. And if you want more brutally honest personal finance takes that most people are too scared to say out loud, hit that subscribe button because we're just getting started.